Good morning, and this is the Monday version, of course, after the beautiful time zone challenge and change. I hope yourself and your children are enjoying this. I'm at home this Monday with a slightly ill daughter. I'm not feeling the best myself, but there's something in the news that I really want to make sure to share that actually has brought my spirits a little bit up, and it's twofold. The first, we have Macklem, of course, from the Bank of Canada, saying that they could actually be looking at cutting rates before inflation reaches that target. You know, for the last 18 months, all he's been doing is talking about this 2% target. It's been his nonstop focus, and now they're saying, well, we need to, see, maybe we might actually start going down a little bit further. Of course, they always add in that the bank has not ruled out any further rate hikes. However, based on the forecast, it looks like it's going to remain and not increase in that potential that it could be going down even further. It's hard because they're always setting this overnight rate target, into the future. So they're trying to use their best guesses and best estimates. But the rhetoric is around the fact that, with where the markets are at, that we could actually be seeing some decrease, obviously due to the supply problem. So this is some great news. I'd say made my Monday morning feel a heck of a lot better. In addition to this potential on decrease of rates, we also have bond yields that have been trending and decreasing quite significantly. This is from a good friend of mine, outlining basically we've already seen slide, and that's now down to more than 60 basis points from its recent high in early October. So when the bond yield decreases, fixed interest rates, which are tied to this, then also decrease. It does not generally always decrease in a tandem, so it's not like if bond yield goes down 0.6 that immediately fixed rates go down. Sometimes the banks like to keep and have a little extra profit. So we've seen thus far already the fixed rates on the insured signs from some of our lenders, such as First National. You can see this black is the updated decrease on that. These are insured, so meaning either insured or insurable, and then we're yet to see the conventional uninsurable. So this would be for purchases over $1 million, or when you're putting down 20% and you want to have a 30-year amortization. We expect to see that decrease, however, coming later this week. This was, of course, the first lender to move on the rate, so we expect we'll see more lenders joining alongside in that. Now, if you're wondering, James, well, should I be then still taking a fixed? We've been saying this for the last few months with the expectation and seeing of overnight lending rates coming down, or prime to be coming down, with now all the major 5 banks having put out about a month ago now that they expect this overnight rate to decrease by 0.75 to 1.5. We're still sticking with the belief that variable is going to be the best strategy for anyone that's buying or renewing into this time. Trying to time it with a 2-year fix or a 3-year fix, or even worse, a 5-year fix. We don't know exactly when and how much that prime is going to go down. So the only way around that and best solution and strategy is taking a variable mortgage, which automatically comes down. Now, what we're finding is a lot of clients are a little concerned, or maybe have some trepidation to take a 30-year amortization to allow for their payments to be lower, and also, or they're concerned because maybe they're coming up for renewal and they had taken a 30-year, years ago. Now they're down to a 20-year. Well, the good news is there are solutions, and ironically, TD is, as you can see, some of the TD marketing and ads on the side here, is actually a pretty good lender as far as a solution to this. They have a variable mortgage that has what's called a static payment. Okay, so this static payment over the last couple of years has been a little bit of a pain in the butt because payment did not move. Amortization, though, however, did as prime increased or as prime went up. So people are having results of variable mortgages now that are 60, 70, 80 years long. What I don't want to see is someone say, well, that wasn't a great solution the last couple of years, and make a mistake now. It's actually a great time to be taking that static payment. If you have trepidation and you're looking and say, I don't want a 30-year, well, great. Take the 30 years so you get the lowest payment right now. As prime comes down, your payment will still stay the same, but as prime comes down, then your amortization will automatically come down. You of course, can take a variable or a variant or adjustable mortgage variable. What that means is as prime comes down, your payment will come down, but then your amortization will stay the same. So to have that effect, as prime comes down, you'd have to then go in yourself and increase the payment. So having a static lender, a static variable such as TD, which we of course work with as one of our primary lenders, by taking that one in a longer amortization as prime comes down, you will have that automatic solution, ergo your amortization will come down with it. I'm James Lowen from the